Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thanks so much for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from our Wilson Investment Properties headquarters in Silicon Valley. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. You can also go to TomWilsonProperties.com to sign up for a newsletter on the economics as it relates to real estate and news that's in real estate. It comes out on a weekly basis. Also, by so doing, you get to sign up to our client base so that as we're introducing new syndications, you will get access to those for most of our syndications with Wilson Investment Properties, who is the sponsor of this program. They can only be offered to those that have a relationship with us. They were typically commercial and multifamily properties across the country that give great rates of return with no liability to the investor, and they are passive, and the shares are typically about $50,000 per share. So we also can go on there and ask us questions. We're glad to respond and let us know any of your interest in topics or guests that you would like us to have on the program. Today we're going to be talking about asset protection, something that's pretty important. Every one of our syndications that we do have asset protection on them, and sometimes if you have a partnership with someone, in cases like that and others, asset protection is very, very important. So we have an expert with us today. He's an attorney who is Scott Smith, and he began his career in corporate law. He's from Albany Law School, and he's a real estate investor himself. I always, recommend folks on your professional team who also are investors, because they're gonna, once you got skin in the game, you've got a lot more incentive for learning how to do things correctly. And he's owner of Royal Legal Solutions in Austin, Texas, one of the top asset protection companies for real estate investors in the country. Scott, welcome to the program.
Great to be here today. I'm really excited to share people some great strategies about how they can really protect themselves in ways that kind of make sense as an investor. And we know that as investors, it doesn't make sense to spend a bunch of money doing something that's unnecessary, and trying to find that sweet spot of what works for people and what makes sense is a really, really cool part of my job. And we really got into this initially, as you know, Tom, and there's just so much misinformation out there online and all over the place that you end up finding into. I'm sure you've run into that before.
Surely, and the problem I think with most professions is some of it's a matter of opinion. So you get sometimes people with good intentions and good information, but it has different perspectives, and in the end, the client or the investor has to make the decision themselves. Indeed, but there's value in everything you learn about that. You make an important decision. You can't rely on one source, or you can't rely on a source that you don't have calibration on. So Scott, tell us how you got into real estate investing. What planted the seeds for you to do that?
Yeah, I got into it about 8 years ago or so. I was in law school and actually bought my first property then, and ended up selling that property and flipping it after law school. And then that's where I caught the real estate bug. Is from the time I was a kid with Robert Kiyosaki, reading Rich Dad Poor Dad, and then coming through to actually doing my first deal there, and did litigation for a while after I got out of law school. Left that and wanted to go back to my true love with real estate, and found that amongst the real estate community of investors I was looking to do deals with, a lot of them had no idea about efficient ways that they could be protecting their assets and hiding their ownership. I've come to find out that was really important to a lot of people, and as it was to myself as a litigator. I mean, I knew that if you could hide the assets and protect them, then that's the way that you would stop the lawsuits before they would even start. And since then, we've been running Royal Legal Solutions here for a little over 4 years. We have over 1,000 clients all across the country and every single state in the United States, in every asset class. So we typically specialize in the 1 to 4 unit person that holds, looking to scale up their unit holdings with 1 to 4 unit properties. But I'm in all kinds of deals myself too, in over 10 different states and just about every asset class as well. So
are you supporting clients with your with your company, Scott? You when did you establish it? How many years ago?
Royal Legal Solutions has been in existence for a little over 4 years now.
Okay.
That's right.
And you have clients throughout the country?
Yeah, we have clients throughout the country, everywhere, and every asset class, from notes to single to multifamily to apartment complexes, commercial, everything.
Okay. All right. What do you think is one of the biggest mistakes that real estate investors make relative to protecting their property and themselves?
Yeah, I'd say the biggest mistake people make is that thinking that their insurance coverage is enough to protect them. Insurance is great. I believe in being very well insured myself, and I am. But there's, we've all seen it, on TV and, all over the place what are the circumstances when insurance will deny coverage, right, to suit their own interests. People think that insurance companies are benevolent, and they're not.
Yeah, the exclusions seem to be just increasing every time you get declarations pages and so forth.
Yeah, and who knows?
You don't know something. You don't know something's excluded until it's too late, right?
Right, you don't. And that's why I would say, well, insurance covers you for about 80% of what can go wrong in your life, but that's why you have asset holding companies. And that's what one of the main strategies we use. And for an asset protection is an asset holding company. That covers the extra 20% and closes the loop on your protections. That way the skies can fall and you're still okay. And that's ideally what you want.
Can you give an example of something that insurance won't protect you against if you own real estate and you don't have it in any kind of entity structure?
Yeah, so the number one worst way you can possibly hold real estate is in your personal name, because that means a lawsuit against you, they can take everything that you own, all of your real estate investments. And those examples are really straightforward. That can be just as simple as a car accident that exceeds the limits of liability of your insurance coverage. Now, they sue you personally, it can come after your bank accounts, all of your real estate, et cetera. And the one thing that makes real estate especially bad is because real estate discloses to people exactly what the equity value of a property is and how much is owed on it. So it's really like a big orange sign that says, please sue me because here's all my money to come after.
Okay. Any other examples you can think of where insurance won't cover you?
Sure. Insurance also won't cover you for any claims. Well, you should only think of insurance this way, is that insurance only covers you for normal accidents. That'll happen. Like a slip and fall on your property, insurance is going to cover you for that. But let's say that anything outside of the normal circumstances happen, like grandma falls through the rotten staircase on one of your properties, all of a sudden the insurance company will come in and say, well, that's not a normal accident. That's just called negligence. I'm going to say that's actually called gross negligence. When something's called gross negligence, it's not covered by any insurance policy no matter what, right? Because that's a condition they're going to say you knew about it or you should have known about it and you should have done something about it. The problem is that insurance companies are profit-motivated companies, right? So you find that when they make the determination of whether it's negligence and they cover it or gross negligence and they don't cover it, has everything to do with how much money they end up having to pay out to be able to take care of the claim. When it's grandma falling through the staircase and she's permanently disabled, all of a sudden now it's gross negligence because now it's going to be a huge amount of money they have to pay out and they don't want to, which leaves you in the position of having to sue your own insurance company if you had the resources to even do that. So it's, I've seen situations where clients have lost millions of dollars from a single lawsuit, right? And this isn't clients of mine that had our asset protection in place. This is, before they knew that we existed. And then that's when they called me up and said, hey, Scott, I got to have something in place because I can't take that hit again. I said, great, well, we can make sure you're protected. And here's how you do that.
Okay. All right. But, so did you just recognize from observing others that what the potential liabilities are, or do you have any personal circumstances that kind of forced you to do that?
Well, I see them all the time because my background was a litigator, right? So in my litigation background, I was seeing cases frequently about, about who do you want to sue. If you don't know about the way the litigation game is played, what really happens is somebody comes into an office of a litigator and says, this bad thing happened to me. The litigator says, great. The next thing the litigator does is immediately go look to see if that person has assets to come after, right? So if they can find that person has significant, or company has significant assets to be able to pursue, they'll go ahead and file the lawsuit knowing that they can get a settlement out of it, or proceed with the lawsuit just in general. It doesn't really matter what the facts of the case are because any litigator can trump up a case. Like we all have heard those stories, and we all know that to be the case. So what we try to do is always to hide the assets of all of our clients and have them protected. So that way if anybody looks to sue, it looks like there's nothing there for them to come after. Because that's the benefit of having anonymity. And there's some really cool legal ways to do that don't actually cause any extra complexity or any extra costs associated with it, more than just your normal company structuring.
So the first thing you like to do is to help hide it from a potential lawsuit, and then do some structure about it. We've got about 30 seconds left on this segment. Want to talk anything else about what you got to be careful about until we dive into how to fix it?
Yeah. The other things that you just want to be careful about is that you want to make sure that you have the insurance. You want to make sure that you have a good company structure. You want to make sure that you're anonymous, and you want to make sure that your company structure is actually maintained correctly. Most people that set up the company structures don't maintain them correctly, and so they don't provide any actual protection at all.
That's a very, very, very good point. That's one that I think is probably often abused. We have with us today Scott Smith, who's an expert in asset protection. He's owner of Royal Legal Solutions in Austin, Texas, who helps real estate investors around the country. And we're talking about what the potential problems are with not having a asset protection. And now we're going to talk right after the break about what to do about it. So stay with us, and we'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We're pleased to have today Scott Smith with us, attorney with the company Royal Legal Solutions that provides asset protection for real estate investors. So Scott, let's dive into it. Someone comes to you and says, "I've got a dozen single-family home rentals scattered around the country. I've got insurance on them, but they're all sitting in my living trust or my individual name. What's your advice?"
So I would say if you live in anywhere besides California, you can look to set up what's known as a series LLC. If you're living in California, you can't do that because of franchise tax reasons, so you need to form a Delaware statutory trust. But the name of the game here is that what you need to do is always, in any business or as a real estate investor, you got to separate all of your assets from all of the liabilities. So all of the assets would be your cash, your homes, all of that needs to be structured in one company. We're going to call that an asset holding company. And separately, you need to compartmentalize all the liabilities of your life into a shell operating company, which is typically an LLC that doesn't own anything, but it conducts all the business affairs. It collects the rent checks from all your renters. It signs all the contracts on your behalf. It's going to be doing everything that is your face to the world, so to speak. So that way, if there's ever a lawsuit, the person that can sue is that operating LLC that doesn't own anything.
Okay. All right. So can you expand on that a little bit for us?
Yeah, for sure. I would say after you set up your operating LLC, the question then becomes as what do you want to use to be holding your assets for an asset holding company? For 49 states, you can use a series LLC structure. You can form that up in a number of over 12 different states, and you can form them up in one state and use them anywhere.
All right.
People have been doing.
So tell us give us some detail about series LLC.
Yeah, for sure. The main thing to know is that there's, you can form up in the 12 states, like you could form it up in anywhere, like Texas, for example, and then use it anywhere, just like people have been using with Delaware LLCs. And you form them in Delaware and use them everywhere else. The series LLC is special because it allows you to create an infinite number of LLCs for free on your desktop. For example, in Texas, there's no filing fees to create a new series of a series LLC. So after you do the initial filing for the parent, then you can create what's known as a child series of that series LLC by merely signing a piece of paper that has the full effect of creating a brand new LLC. So you'd have child series A, child series B, child series C, et cetera. For each series would hold one property. And that's the way you compartmentalize every single asset that you would own. So if there's a lawsuit involving, property A, it can't touch property B, C, D, et cetera, down the line. So at worst, you only lose one property.
Right. Okay. So compartmentalize it. Plus, also, is there concern if it's just owned by an individual and their spouse? Is there a concern for a single member entity that can be the corporate veil can be pierced on?
Yeah, this is where it really matters where you form the company at. So if you form it up through a state like Texas, and I can form these up anywhere, but I choose Texas because Texas is cheap and strong. And if you form it up through Texas, then no, it can't be. If it's a husband and wife or a single person, it won't. If a Texas entity is performing an action, say in Georgia, for example, and then now there's a Georgia lawsuit that's involving a Texas entity, Georgia will then look at Texas law to see what are the protections underneath Texas law for that LLC. This is why people initially always formed things in Delaware and used them at other places, is because of those types of protections that they wanted to take advantage of.
Okay. So Delaware has some, and others like Wyoming and Nevada have some stronger protections than other states.
That's right. Yeah, and you'll typically always want to form in Delaware, Texas, Nevada, or Wyoming. Of those, Texas has a one-time filing fee and no annual fees. So it's the cheapest of those to use. And so typically
better than Wyoming?
Yeah, Wyoming has annual fees associated with it.
Okay.
Texas is the only one that doesn't.
Continue that right after the break here, Scott. We have Scott Smith with us, expert in asset protection, especially for real estate investors, and owner of the Royal Legal Solutions in Austin, Texas. So when we come back, we'll get more from Scott on how to protect your assets. So stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
So, Scott, we're talking about right now the Series LLC, and you like Texas because you feel the protection is great, but there's no recurring fees for annually for the entity that you have. So, and you indicate that the resistance to being pierced as a single member entity is sufficient in Texas, and you don't need to go to Wyoming to do that.
That's right. You don't need to go to Wyoming to do that. And there's a lot of good reasons to think that the series LLC itself is a very strong structure. One of the things that we hear about a lot in my industry from the keyboard warriors online and from other attorneys that don't really understand the complexities of this is that, there's not a lot of case law that involves the series LLC, even though it's been around for 20 years. You don't find anybody's challenging these entities in the courts. So some people will look at that and say, well, there's no case law. I can't be sure the way it's going to be treated. I look at that and say, yeah, for over 20 years, the people that are most incentivized to be able to attack these structures, which would be the litigators and all of these thousands of cases they've been involved in, haven't done so. And it must be because
I like
they're going to get paid for attacking it.
I like that theory. So let's move now. We probably have the majority of our listeners in California. So let's talk about why the series LLC doesn't work here as well, and talk about Delaware statutory trust.
Yeah, so the series LLC doesn't work because it's going to get you taxed just like every other LLC at $800 per series or per LLC. So you can't do that in California and be profitable.
So it would work as a liability protection, but it's expensive and there's cheaper solutions.
Correct. Yeah, that's right. Yes. From a business perspective, it doesn't work. The better business perspective to use on that is use what's known as a Delaware statutory trust, which has the same type of series compartmentalization that we talked about before with the series LLC, and it's not subject to the franchise taxes, so you get to avoid those fees, and it's able to be a pass-through entity, just like the series LLC, so it doesn't complicate your tax returns into it.
How does it? How does it avoid the California franchise tax, since they claim that wherever you live is what it's based upon, not where the LLC is or where the products are? Yeah,
that's right. Well, it's not an LLC. That's why. It's because it's a trust, and the trusts aren't subject to franchise taxes if they're structured correctly. LLCs are, and corporations are, but by statute, it's not. Mm-hmm. Right? So you take that around and you say, well, typically trust structures like land trusts or living trusts provide no protection at all on their own, right? They always have to be paired with a company. A Delaware statutory trust is a special kind of trust created by Delaware statute that does provide very strong asset protection benefits to it. And you'll see that the DSTs, as they're known in the industry, are used in really large commercial type deals with 1031 exchanges. So they're very strong. They're very well established. You wouldn't ever use them if you weren't a California resident, because they're a little bit more expensive than these series LLC structures.
I was going to ask you why not use them in other states. Yeah. So it's a little more expensive, but it's cheaper than the series for California because they're LLCs and you get taxed on each one of them.
Yeah, right. Well, just being in California, you get the blessing of high taxes for everything. So everything is taxable for California.
Certainly. Yeah. Well, it didn't take you long to figure that out, even though you live in Austin, right?
I'm telling you, this is why we got into it. It's because everybody's like, how can you save us money on taxes? Like, here's a great way. We can save you thousands of dollars a year, and give you protection.
All right, let's continue that in a moment here. We'll bring back Scott, who's talking to us about asset protection, and we'll be back right after the break. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Scott Smith with us today, the asset protection attorney for real estate investors. talking about for California the use of DST. So our Delaware Statutory Trust, not to be confused with Deferred Sales Trust, which unfortunately has the same acronym. So Scott, can you tell us a little bit more about what this is and how we use it?
Yeah, so I mean, anybody that has property held in their personal name needs to have, in California, needs to be using some type of structure, and the LLCs are just too expensive. So, in terms of the $800 per year, so the DST allows you that compartmentalization while avoiding that $800 in franchise tax. And the great thing about them is that you carry on your life and purchasing the assets the same way you would do right now. You purchase an asset in your personal name. That allows you to be taking advantage of all the conforming loans that you're going to want to for your 1 to 4 unit properties as you acquire them. And then afterwards, what you do is you'll transfer that property into what's known as a land trust. And the land trust helps you accomplish anonymity because it's titled with the name of the location of the asset itself, like the 123 Main Street Trust, for example. And then that land trust is actually owned by the Delaware Statutory Trust. So
the land trust gives you reduces your visibility to a potential litigator, but being within the Delaware Statutory Trust gives you the liability protection.
That's right. Yeah, the land trust on its own, there's no liability protection, just like living trusts. You need to combine them with an asset holding company like an LLC, or in this case, a Delaware Statutory Trust.
So how does the land trust? How does the land trust give you insulation from being known publicly?
Because land trusts don't have to be filed, right? So that because there's a private document that's used to create it. So to actually prove ownership of the trust, if you want to transfer title, you actually have to produce a physical document to the title company for them to do.
Is there
that.
any risk with that?
Sure. I mean, somebody could, fabricate a land trust, right, to try to steal the property from you, I guess. Just like in the same way somebody could produce a fake ID and notarize a deed in your name, right? But those types of fraud issues that come into place with that are very, very small, very infrequent. Does anything like that happen? The great piece about using a land trust when you make the transfer is that it doesn't violate the due on sale clause of the mortgage that you got. So typically when you get the conforming loans, there's this clause that says if you transfer it into an entity, like an LLC, then the note can be called due. Land trusts avoid that issue. And they avoid that issue because from the letters I've seen from the back end of the banks is because the banks just don't review trusts anymore because they stopped getting out of the business of reviewing trusts when everybody was transferring everything to living trusts. So they just blanketly exempted them from any of the review process. So you won't have any trouble.
Yeah, about 20 years ago when I was buying a lot of properties, the banks wouldn't accept a living trust. I had to buy it in my name and then transfer it over.
Yeah. I mean, these entities and these structures have been around, for about that long, right? I think, it's in legal terms, these are new, but they're not new, right? I mean, like they've been around the block a few times. It's just that, I think most legal thought, I think, is way behind the times, which is why I really enjoy my job being an investor as well as an attorney to help share with people saying, here's actually the cutting edge stuff. That it's only 20 years old. It's cutting edge,
So you can put so the Delaware Statutory Trust, because it's a trust, doesn't get hit with any California franchise tax, and within it you can compartmentalize other multiple properties that you own.
Yeah, you can compartmentalize anything. With either the Series LLC or the DST, they're not just for real estate. It's any asset they can hold. They can hold excess cash, meaning like more cash than you should have just in your personal bank account. You can hold your stocks, you can hold your car collection, anything.
Okay. Now, do you still have a separate operating company?
Yeah, I would almost always, if you need to. If you have a property management company, then you probably don't need a separate operating company because they're really taking on all the liability for you in terms of who they're interacting with and whatnot. But if you're managing properties directly or otherwise engaging in business in the world, you should always be doing that through an LLC, a completely separate company than your asset holding company.
Okay. All right. What else do we need to know especially for California investors about
so
DST?
I would say one of the great things is that for a California investor is that you it doesn't matter where you're owning the assets. Anywhere in the country, you can own it through the DST, and you can also own it for your California home as well. You can operate directly there.
Okay, so you can put your own primary home in it.
Yeah, put your primary home in it too. Why not, right?
Sure.
And then that's a great piece about California, which is that another piece of the drawback is that if you have an LLC, let's say in Georgia, that owns a Georgia piece of property, but you're domiciled in California, according to the FTB rules, the way they're written, you could be subject to that $800 per year franchise tax. And I see a lot of professionals advising their clients to pay those taxes every year. And my viewpoint is, let's set up something where we can avoid having to pay those taxes wherever we can.
All right, because I guess there's a risk if you don't pay it, then you may be disallowed by a state.
Well, the California will then could potentially come after you, right? To say, hey,
Right.
You owe us money for the LLCs. I personally think it's a ridiculous rule because what is California's business and what an LLC in Georgia does with owning a Georgia piece of property just because you live there? But that's the way they crafted the rule, right? So you have to ask yourself if you want to have that fight or not. And you can just totally avoid it if you use a Delaware statutory trust because of the trust structure.
Sure.
It's not inside the rules and not on their radar.
And also, I guess if you don't pay the franchise tax, if you had an LLC, then maybe a litigator could argue that it's not a valid entity because it hasn't met all the requirements of being a valid entity.
Well, you can know for sure that if you ever end up in litigation, you're going to have a litigator that's going to argue every possible thing that they can come up with, which is why preparation is really key, right? I have it on the bottom of every email that I have is that law favors the proactive. Because what ends up happening, at the end of the day, I have clients that have lawsuits against them dropped all the time, merely because the structure they have in place is so strong that the litigators look at that and say, I don't even want to go for that.
All right, let's wrap that up when we get back here in just a moment. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
It's been a pleasure having Scott Smith with us today on who owns Royal Legal Solutions in Austin, Texas, and he has a firm that specializes in asset protection for real estate investors, and he's told us about what the potential problems are by not having protection and what the best ones are to have if you're out of California or within California. So for our most of our listeners who are in California, what's roughly it cost to set up a DST?
Yeah, it depends upon the size of what all the assets you have are, but it's going to probably be somewhere in the range of like $5,000 to $7,000 as a total setup cost, all in. And so what you'd be looking at, somewhere in there.
And then is that on top of that would be a certain fee per property that you're adding to it, or does that include a handful of properties? Yeah,
I'm including a handful of properties in there. Typically, you want to budget about $300 per property to transfer the properties in for the deed and whatnot. Then you're probably looking at around $600 or so per year in annual maintenance. But that's for all of them. No matter how many you scale up to properties, those fees shouldn't increase for you.
And does that include the land trust?
Yeah, that would include the land trust, the deeds, creation of the series, ongoing legal support, all included in those.
All right, and then as you buy more properties or sell properties, then you just move them in and out of that same Delaware statutory trust.
Yeah, that's right. And so as you move properties in and out, acquire a new one, you're only looking at a $300 fee to be able to move that because it's just a new deed and a new land trust.
Okay.
So
Scott,
it's very
if they want
cheap
more,
to scale, which is a great piece.
If they want, if our listeners want more information, what's your contact?
Yeah, you can always go to the website, royallegalsolutions.com, or call us at 512-757-3994, or email me at scott@royallegalsolutions.com.
Okay, fantastic. Any closing comment or thought?
Yeah, the one thing I would say to everybody is that I'd really encourage you to reach out to get in contact with us. We have a ton of free information. We'd be happy to share with you what we know and see if there's a fit for what it is that you think that you need. And happy to get, our goal is to get everybody protected to whatever level, they think that they need to. So we'd be happy to talk to everybody.
Okay, great. Thank you, Scott, and for helping to inform us and our listeners on what kinds of options are available and what can be done to help give asset protection. So thanks everyone for tuning in today and listening to our program on asset protection with Scott Smith. Remember to go to tomwilsonproperties.com and sign up for our newsletter that will give you weekly information on what the hottest items are and interpretations about the economy and how it's affecting real estate and affecting your decisions on timing and what kind of asset classes to be in. Also, by so doing, you will automatically be signed up to the Wilson Investment Properties client list. So that gives you access to new commercial syndications that come out every few weeks, which gives you passive investments without liability and for as little as $50,000 a share. So it's always great having our guest on. Thank you again, Scott. And remember, the only thing that matters is what you do next. So we'll look forward to having you back with us on the next program.